How do you value a startup? Is it an art? Is it a science? Well, in today's video, I'm going to help you understand startup valuations and how to spot a good one or how to spot a bad one. All right, look, the valuation process can be a little bit of a mystery, and I'm going to do all that I can to kind of simplify it today for you and help you gain confidence in a world that sometimes can be very confusing. So here is what we're going to be covering today. We're going to be talking about why is a valuation of a startup so important. We're going to talk about pre-revenue startups, and we're going to talk about post-revenue startups, and we're going to talk about the different valuation models that are out there right now. So if you're ready, let's dive in. So why does a startup's valuation really matter? Well, this is really important because it's when you are staking your claim into this company. Look, we all want this company to grow. We want it to grow fast and far beyond what we invested and when we invested. But the way I try to tell it to people all the time is you got to kind of think about early stage investing like when you're looking for and buying a house. Let me explain. Look, everybody knows that when you buy a house, that is when you make your money. You make all of your money on the front end, meaning if you get a good deal on the house, that no matter what the market does, on the other side, you should be able to get a return on your money. It's not, I'm going to pay a lot of money up front and then I'm going to do a lot of remodels and renovations and I hope that I'll make money. No, you buy the house at the right price on the front end and that's where you make your money. Well, the same is true about early stage startup investing, right? When you invest on the front end, that's when you make your money. It's all about what the value and the valuation is of that startup, okay? Now, we are in interesting times when it comes to the world of startups. We've seen a boom in startup investing really since the '08 crash or the recession, I guess. And what happened on the other side of that, we were in kind of a bull market for a very, very long time. So startups were coming out with really, really high valuations, and all these VC firms and hedge funds and big angel investors, they're all dumping in their money. But then they got ridiculous valuations on the other side. It was more about this life of like, look, you don't have to make money as a startup. Just go get users, get millions of people to be users, and eventually someday you'll end up making money. I mean, the crazy part, here we are in 2023, and Uber just was profitable for the first time not that long ago, which is wild. But those days are over. No longer are VCs and hedge funds looking for companies that are like one day going to make profit. They want to see companies who are profitable right away or close to right away, right? So that is what's happening now in the landscape inside the startup world. So startups who maybe had a plan and their valuation just kept getting ridiculous because they were just going to go get users, that's changing the way they're looking at and valuing their companies. And it's changing the way that early stage investors, hedge funds and angel investors are jumping in right now. So here's what's happening. Founders are scrambling, right? Some of them are scrambling because they were like, look, I had a model that was based off not making profits for a very long time, and now I have to change that game. So they may have had a plan and they were valued at $40 million and people invested in them. But a lot of times what's happening, I saw a chart earlier today that talks about how down rounds are now actually a regular occurrence, meaning someone who raised at a $40 million valuation needs more capital to continue to grow and keep the lights on. So they go out and get more money, but they do it at a down round. Maybe they do it at a $30 million valuation or $25 million valuation. Now, that doesn't help the previous investors, right? It kind of dilutes and devalues their original investment. But a lot of times, sometimes that's what founders actually have to do to keep the lights on. So those early investors aren't happy about a down round, but they'd rather have a down round than the company completely and totally closing the doors, turning the lights off, and them never possibly seeing a return on their capital again. So down rounds, and also here's the other thing that's happening. Founders who typically would go to VC or hedge funds or big angels, well, a lot of that money's parked on the sideline. They're waiting to see what's going to happen inside of the economy. So 70% actually of VCs and hedge funds have declined and pulled back, and they're just holding their cash. Well, now founders are like, where can I go get money? Well, here comes the crowd, right? They show up to the crowd and they would like to raise money from the crowd. Now, the part that we still have to get better at, the crowd as a whole, is saying you valued your company too high and we're not going to invest, and you have to make a decision if you're going to change that or not. And that's the cool part. Founders can make whatever decision they want, but also so can investors. This is a very good place because it puts us in the driver's seat, especially when it comes to the crowd. So it's a good day for the crowd. Bigger companies are showing up. They're still in that battle of trying to realize their valuation. Just because we're the crowd doesn't need to be high, that it needs to be right. And as we become more savvy and educated in this space, people are understanding what a good value and what a bad value is, and what comes from a down round or an up round, and all the different pieces and parts in between. So let's take a step and drive down the world of pre-revenue valuation. So what does this mean? This is like turning the lights off and shooting in the dark when it comes to investing. Look, or these founders providing their valuation. It's like, I have an idea. I think I'm worth $4 million or $40 million. Look, one thing is always going to be true. Founders will always think that their startup is worth more than it actually is. I typically don't meet founders who are like, no, I'm not worth that much money. I'm definitely worth this much money down here. They're always going to try and hold on to and keep as much of their equity in their company as they can. And here's the thing, with pre-revenue companies, it's even more wild, right? So we see Shark Tank examples, right? People show up on the show and they're like, I'm valued at $5 million. And then they ask them, what's your revenue? And they're like, well, I haven't made any yet, but we're going to make some yet. Look, pre-revenue companies, as far as my opinion goes, has no business raising from the crowd and going the route of equity crowdfunding. They just aren't ready yet. Now, sometimes it's hard for them to hear that. And sometimes I share that information with founders. I say, look, you're not ready yet. So what I typically do is I just don't invest in pre-revenue companies. I want to see a company that's made traction. Now, there are a couple considerations that you have to think of. Maybe something where they have like patents or technology, right? And this is a great example of like someone in the pharmaceutical or the biomedical space. There's a lot of FDA hoops, right? They have to walk through. So it takes a while for them to get approved so that they can actually get into revenue. But those are just a real small example of ones that are pre-revenue that I would actually get excited about. So here's the thing. If I meet a founder and they have an idea for a widget, and it's going to be the best widget, it's going to take everyone to Mars, and it's going to be the best thing ever. So what I always tell them is like, hey, show me, go do something, come back in 6 months, 12 months, and show me that you've been able to figure out that there's a market out there, gain traction, and convince people to buy your product, that you're actually solving their problem with your solution. All right. So that is where I stand on pre-revenue companies in the world of equity crowdfunding. So let's dive into the world of post-revenue valuations. This is for companies who are actually making money. Now, this is something very important you have to understand. This can range from a startup who is making a few $1,000s a year or a month to $4 to $5 million and even beyond. But that does not always tell the story. If someone says, well, we're making $4 million a month, that could be great, right? But they just may actually be losing an extra $1 million a month, right? So this is something called burn, the cash that they're lighting on fire and they're burning. And a lot of times a company to get off the ground and scale, they do have to have a burn. But what you want to see in a startup is seeing that burn slowly start to get smaller and smaller and start to see profitability overtake that burn. Now, if a company is burning through a bunch of cash, right, and they can't get their spending out under control, what's going to happen to them? They're going to flame out, right? They're going to be gone. They're going to be dead. They're going to be a dead company. Now, just because a company is in revenue, I really need you to hear this, does not mean that that supports a higher valuation. Traction is good. Yes, we love traction, and that can be rewarded. But remember, this is a point. If you take anything from our time together today, this is what I want you to hear. Founders will always price their startups higher than it really is. Look, it's their baby. What do we feel? What do we feel about our baby? We love our baby. There's nothing cuter or more precious than our baby, right? Now, oftentimes I ask founders, hey, how'd you come up with this valuation? And the answer usually goes something like this, and it's somewhat underwhelming. They usually say, well, we looked at our competition, we saw what they were, and so we priced it like them. Or our last raise was at a $4 million valuation, so here we are 6 months later or 12 months later, now we're at an $8 million valuation. But they have no way to explain the increase or explain, how that number has actually gone up. Their explanation is usually pretty weak. Now, sometimes they'll say to me something, well, we saw XYZ company, who's much bigger than them. We saw what they did and we followed what they were doing. So we figured we would price at the exact same price because we're in the exact same space. It's like somebody who says, hey, I got products and I want to sell them online. I'm going to value myself the exact same as Amazon, which we all know is not the case. Now, I'm not saying all of these answers are bad, but what I am saying is every founder, when asked, should have a very, very clean answer as to why they chose to value their company at the price that they did. Now, as a bonus, here's something really fun you can do and see what the response is ask them if they have decided or spent money to get an outside valuation on their company, done by an independent analyst to give them a real clear understanding, a non-biased understanding of where their company is and what their company should be valued at. So, as a rule of thumb, if you see a company that is barely in revenue, but they are raising at a ridiculous valuation, you have to always ask more questions, right? Dive deep and try and get more clarity on it. Look, if I see a company that is, deeper into revenue, like maybe they're doing $2 or $3 million a year, but their cash burn, like maybe it's good, maybe it's not. Like, I'm not as scared at the higher valuation if their burn is low and the revenue is high and they're showing me that they have traction. Always something you want to look at, right? Are they doing this? Is their sector doing this? Is it going down or is the sector going up and they are riding the wave? Definitely something you want to do. Now, really, here's the biggest question that we all have to ask ourselves, right? When you're investing, this is something you got to be thinking about. What do I think this company could actually get acquired for? This is when the valuation is very, very important because look, if they're valued at $10 million and it's going to take them 5 years to get bought for $20 million, that just is not strong enough, in my opinion, to move the needle for me to get me excited. But if they are a software company, software as a service, a SaaS company, or an AI startup that has traction, they're in revenue, has great margins, and they could be purchased. Well, they could be purchased down the line for 10 or 20x their current valuation. Well, that's going to get my attention, right? So definitely something that you want to make sure you watch and understand that the value comes on the front end. All right, well, let's dive into valuation methods and kind of some of the different ways that people look at startups when it comes to setting a valuation. I actually recently just wrote a full article on various popular methods used to help value startups. And I've actually dropped the link in the description down below, and you can check that article out for free, okay? Now, some of these methods are closer to each other and others they're wildly different, right? So you're going to have to decide which process or with methodology works best for you. And that's what this entire process is all about: gaining knowledge, gaining information, and figuring out what works best for you. Here are a couple of these methods that I wrote about inside of this article. And a lot of them can vary widely, right? Some of them are pre-revenue or post-revenue. So I'm going to quickly just hit these and you can go look them up on their own or read that article to help you kind of understand how they work. There's the scorecard method. There's the risk factor summation method. There's the discounted cash flow known as DCF. There's price to earnings ratio, PE. There's market comparables, traction comparables, the Burkus method, and the venture capital method. There are others out there, but these are some of the most popular ones that you can use out there when it comes to valuations and learning how to value a startup. Now, I hope that this gives you some clarity on the world of valuations. Look, at the end of the day, if you don't feel like the value of a startup is worth it, well, the good news is this: you don't have to invest in them. Remember, this is your portfolio and this is your strategy. No one else has to make the call for you. You're the one that gets to do it, okay? So if you haven't yet subscribed to the channel, please make sure you do it to stay up on all the things happening in the world of equity crowdfunding. And if you have not seen the master plan on how I plan to represent you and me and the crowd on Shark Tank, I unpack the entire strategy right here.